Welcome to the Deep Dive, the show where we distill complex information into clear, actionable insights. Financial news, especially these big earnings reports, they can feel like just a flood of data sometimes. But hidden within those numbers, there are always these fascinating stories. Strategy, vision, sometimes surprising innovation. You get a glimpse of where things are actually headed. And that's exactly what we want to uncover for you today.
Right. Our mission today is to take BlackRock's second quarter 2025 earnings. We're looking straight at the official earnings call transcript and their press release and really go beyond just the headlines. We want to show you how one of the world's biggest asset managers isn't just reacting to the market, but actively shaping the future of finance.
Yeah, think of this as your shortcut. We're pulling out the key insights, the strategic moves, all from the source material, so you can quickly grasp the trends that are going to ripple out across the financial world. You'll walk away definitely well-informed, maybe with a few surprises too. So let's dive in.
Okay, so BlackRock really had a standout second quarter in 2025. They finished with record assets under management, AUM, hit an astounding $12.5 trillion. That was as of June 30th. That's an 18% jump year over year. Pretty impressive.
18% is huge at that scale. And it wasn't just AUM, right? The other top-line numbers look pretty solid too.
Absolutely. Total revenue climbed 13% year over year. That's $5.4 billion. Adjusted earnings per share, EPS, saw a really robust 16% increase, hit $12.05. And their adjusted operating income, that was up 12% year over year to $2.1 billion. Maintained a strong operating margin too, 43.3%.
Okay, so undeniably strong headline numbers. But the net inflows this quarter, there's a bit of a story there, wasn't there? Something interesting.
You're right to point that out. It's a really important detail. So while their total net inflows for the quarter came in at $68 billion, that number was significantly impacted by one specific thing. A single institutional client made a very large $52 billion partial redemption. Low-fee index strategy. Key thing is this wasn't losing a client. It was just a strategic move by one very large entity.
Okay. $52 billion is a massive chunk from one client, though. Does that tell us more about that client's strategy shifting or, could it hint at any underlying vulnerability for BlackRock, even in those low-fee areas?
That's a fair question. But based on what they said, it speaks almost entirely to that specific client strategy. Nothing to do with BlackRock's performance or the product itself. What's really crucial to understand, and they emphasize this, is if you exclude that one activity, BlackRock actually delivered around $116 billion net inflows in the quarter. So the underlying momentum, it's significant.
Okay, so that context changes the picture quite a bit. $116 billion underlying is very strong.
Exactly. And it highlights this multi-year sustained growth they've been seeing. It's coming from lots of different places. iShares, fixed income, their systematic tax-managed strategies, and of course, Aladdin, their tech platform. They also pointed out consistent organic base fee growth. It was 6% for Q2 and the first half of 2025, and actually 7% over the last 12 months, which, is consistently above their 5% target.
So not just growing, but beating their own goals. And that underlying growth seems really solid, even with that one big redemption factored out. It's clear they're playing a long game strategically. And a big piece of that seems to be redefining what they're calling the whole portfolio. This idea of bringing public and private markets together, asset management and tech, looking towards 2030, that feels like a major strategic pivot for a giant like BlackRock.
It really is.
Yeah.
And you can see them making it happen through some really significant acquisitions they've made recently. Global Infrastructure Partners, GIP, that acquisition is a prime example. And what's really fascinating there, GIP's fifth flagship infrastructure fund, it just closed above its $25 billion target.
Yeah.
That makes it the largest private markets fundraise ever for both BlackRock and GIP combined.
Wow, that's incredible, especially because usually wouldn't you expect M&A to cause some disruption, maybe even slow down fundraising while clients wait and see how the integration goes? But you're saying here it actually accelerated it. How did they pull that off? What's this industrial logic they talk about?
That's exactly the key point they made. The industrial logic is just the clear strategic reason and the benefits of bringing these two together. Clients seem to be buying into it because you've got GIP's deep infrastructure know-how and reputation, right? Combined with BlackRock's massive global reach and client network, it signals more opportunity, more stability, not disruption. And it's translating into real deals, too. They mentioned acquiring Malaysian airports, a proposed deal for Hutchinson Ports.
Yeah.
Big global infrastructure finance opportunities.
Okay, that makes a lot of sense when you put it that way. Synergy actually driving growth. So moving on from GIP, what about HPS Investment Partners? Another big one.
Indeed. That deal just closed July 1st. Another really significant milestone. HPS adds $165 billion in client AUM, and $118 billion of that is fee-paying AUM. Financially, they expect it to add about $450 million in revenue just in Q3. And strategically, it massively expands their private credit capabilities, lets them serve all sorts of private financing needs for institutions and wealth clients too.
And then there was Preqin Holding Limited. They bought them back in March, added about $60 million to Q2 revenue. For our listeners, how does a company like Preqin actually help BlackRock and their clients deal with that, information gap you always hear about in private markets? How does it help growth?
Yeah, Preqin is strategically really important. Private markets, well, they're private, right? Less transparent than public markets. Preqin brings the data. Robust analytics, standardized benchmarks, performance tracking, stuff that's been harder to get consistently in private markets. So this lets BlackRock give clients a much clearer view. How is my private equity fund really doing compared to others? What's the true risk in this private credit deal? That transparency builds confidence. It allows for better decisions. And that, in turn, makes clients more comfortable investing more in private markets. It's a critical piece for that whole portfolio idea.
Got it. Making the opaque transparent, essential for growing that side of the business. And finally, there was a smaller deal, Elmtree Funds. What was the thinking there, the tactical fit?
Right, Elmtree. Smaller. Yes, about $7.3 billion AUM, $3.1 billion fee paying. Their expertise is in something called triple net lease. That's where the tenant pays most of the property costs, taxes, insurance, maintenance. It sits at this interesting intersection of real estate and credit. And it's apparently quite relevant for their insurance clients and wealth clients looking for stable, income-generating, real asset type exposure. It fits their overall M&A approach lately, which seems very focused on integrating these complementary pieces rather than just going for huge scale deals for the sake of size.
That makes sense. Bolting on specific capabilities, which flows nicely into talking about their existing core strengths, their ongoing growth engines. And you can't talk about BlackRock's core growth without talking about iShares ETFs, right? Still a powerhouse.
Oh, absolutely. iShares had record inflows in the first half of the year. Impressive 12% organic base fee growth just in ETFs this quarter. And what's really compelling is how diverse those inflows are. Fixed income ETFs, they led the way, $44 billion. Active ETFs pulled in $11 billion. And get this, digital asset ETPs, exchange-traded products, brought in $14 billion. They also made an interesting point about Europe. They see the European ETF market as maybe 5 or 6 years behind the U.S. in terms of adoption. So that represents a pretty significant runway for future growth over there.
Interesting. So Europe could be poised for the kind of ETF boom we saw in the U.S. years ago. That's a lot of potential growth. Now, beyond those core engines, what I find really interesting is their forward-looking stuff, especially digital assets, tokenization. What's the main takeaway there?
The main takeaway. They genuinely seem to believe tokenization is, and I quote, the future. Look at their IBIT platform. That's their tokenized institutional digital asset fund. It crossed $75 billion in AUM at the end of Q2, pulled in $12 billion net inflows. By the time they had their earnings call, it was already at $80 billion. What's smart is how IBIT is bridging traditional finance with crypto markets, and it's bringing new people into the iShares brand. Apparently, nearly a third of the investors in IBIT went on to buy other iShares products. That's a clever funnel. They even have a tokenized liquidity fund already running with $3 billion in AUM.
That is a clever funnel, like an on-ramp. And speaking of entry points, their commitment to cash management is interesting too. Why is that area so important to them, especially since a lot of firms got out of the cash business after the financial crisis?
That's a great point. While others saw cash management as, low margin, maybe not worth the hassle, BlackRock saw it differently. They saw it as a vital client entry point. And sticky assets. People park cash. They've grown their cash AUM to almost $1 trillion now, $22 billion in net inflows just in Q2. Keeping that strong cash business lets them get in the door with clients early, build trust, and then hopefully guide those assets into higher fee strategies over time. It's foundational.
And that cash expertise also connects to the whole stablecoin world now too, doesn't it? A growing role there.
Absolutely. They're now managing over $50 billion just for Circle stablecoin cash reserves, USDC. And they really stressed how important it is that stablecoins are fully backed by safe assets like short-term government bonds for legitimacy, for safety. That's key for trust in that space. And just quickly on Aladdin, their tech platform, still seeing huge demand. Annual contract value, ACV, up 32% year over year. 16% of that was organic growth. Aladdin's really the engine providing the analytics, the data needed to blend public and private markets effectively and have those more sophisticated client conversations.
Right. Aladdin sounds like the connective tissue for a lot of this strategy. Okay, so beyond products, let's talk global reach. They manage a huge amount, $4.5 trillion, for clients outside the U.S. Where are they seeing the most exciting growth internationally?
Well, India is definitely a huge focus right now. Their joint venture, BlackRock, just launched its first funds, raised over $2 billion already, signed up over 67,000 customers. And the goal there is pretty ambitious. Help India's massive population of what they called savers, not investors, get into local and global capital markets, basically financial inclusion on a huge scale. Elsewhere in the Middle East, specifically Saudi Arabia, they mentioned working on expanding the mortgage-backed securities market there. And over in Europe, the Netherlands, they're helping clients navigate this big shift from defined benefit pensions to more hybrid defined contribution systems. That includes landing a massive $30 billion outsourcing mandate from a Dutch client fund, which just started in early July.
Wow, okay. So clearly active on many global fronts. But one area where BlackRock has always been a giant is retirement. What's the latest thinking there, especially around bringing private markets into retirement solutions?
You're absolutely right. Retirement is massive for them. Half their assets are managed in retirement strategies. They've partnered with a company called Great Gray Trust Company. They're offering a target date fund solution that includes both public and private assets, designed for retirees. And looking ahead, they plan to launch their own proprietary version in 2026, called LifePath with Privates. This is a big deal because it aims to bring institutional-style, private market access, potentially, to everyday 401k savers.
Oh, let's connect that to the big picture then. What's the actual argument for putting private markets into a regular person's retirement plan? What's the benefit for someone saving in their 401k to have exposure to, say, private equity or infrastructure? It might feel a bit unfamiliar or complex.
Yeah, the industrial logic, as they'd say, for the average saver is pretty compelling, potentially. Historically, private markets have offered what's called an illiquidity premium. Basically, you might get paid a bit extra return for tying up your money longer than you would in public stocks. They also offer diversification. They don't always move in lockstep with public markets. And access to different types of growth. BlackRock's own research suggests that adding private markets could potentially boost returns by, say, 50 basis points, 0.5% per year over a 30-year period. That could add up to an 18% larger retirement pot. Think about it. If you save $1 million, that's potentially an extra $180,000 without necessarily taking on proportionally more risk if done right.
That is a significant potential difference for a long-term saver. But, given the history of lawsuits around fees and access in the U.S. retirement plan world, does pushing into private markets increase the risk for BlackRock? How do they manage that potential for litigation?
That's a really important point, and they acknowledge the litigation risk exists, especially in the U.S. This is exactly why having strong analytics and data is so critical. It loops back to platforms like Preqin, eFront, which they also own, and Aladdin. These tools provide the transparency, the benchmarking, the reporting needed to justify the fees, show the value, and help fiduciaries, the people overseeing the plans, make informed, defensible decisions. It's all about giving those fiduciaries the tools they need as this trend evolves.
Makes sense. Transparency and data are paramount there. Okay, finally, let's touch on their financials, their framework, capital management. What's the core philosophy? How are they balancing all this growth and investment with profitability?
Their framework is pretty clear. Align organic growth with expenses they can control. They're targeting an operating margin of 45% or more over the business cycle. They do expect core G&A expenses, general and administrative, to rise in the low teens percentage-wise in 2025. But they stress that's mainly driven by integrating those big acquisitions, GIP, Preqin, HPS. So investments for future growth. As for capital allocation, priority one is always investing back into the business, scaling growth areas, driving efficiency. Priority two is returning any excess cash to shareholders, dividends and share buybacks.
And they've been pretty consistent on returning cash, right?
Oh yeah, very consistent. In Q2, they bought back $375 million worth of their own shares, and they plan to repurchase at least that much, $375 million per quarter, for the rest of 2025. On dividends, they aim for a payout ratio of 40–50% of earnings. Their dividend per share has grown at a compound annual rate of over 15% since 2003. Going forward, they anticipate dividend growth in the high single to low double-digit range.
So pulling it all together, BlackRock is showing really strong momentum, accelerated growth across the board. And it's fascinating, like you said, how many of these big strategic moves, the acquisitions, are only just starting to show up in the results. It points to quite an upward trajectory still ahead.
Exactly. They have this incredibly comprehensive platform now, deep client relationships, and this very forward-looking strategy, embracing public, private, tech, digital assets, It really has positioned them, you could argue, for a whole new phase of growth that's tied directly to how capital markets themselves are evolving.
So what does all this mean for you, the listener? It's worth considering how this blending of public and private markets, the rise of digital assets, the globalization of capital, how might that reshape the opportunities and, yeah, probably the complexities, too, for you as an individual investor or retirement saver in the years ahead. What stood out most to you from this deep dive into BlackRock's latest quarter? Something to think about.